Welcome back to The Deep Dive. Today, we've pulled together a stack of sources on a strategic acquisition that, honestly, is flying a little under the radar, but has some massive implications.
It really does. We're talking about HEICO Corporation's move to acquire EthosEnergy Accessories and Components. We'll just call them Ethos A&C.
Right, and HEICO is doing this through their subsidiary, Wencor Group. On the surface, it looks like a standard aerospace deal.
It does. But what we're really digging into here is how this one deal connects two huge and you'd think unrelated market pressures.
Okay, what are they?
Well, on one hand, you have the absolute chaos in the aerospace maintenance, repair, and overhaul sector. The MRO world is just starved for components.
And on the other,
the incredible power-hungry demand coming from the AI revolution. And this single acquisition, buying a niche component repair shop, lets HEICO tackle both of those problems at the same time.
So it's a textbook M&A move then. Buy a specialist and then point their expertise at a totally different hyper-growth market.
Exactly. Ethos A&C is all about high-value, really complex repair work on engine components. We're talking fuel nozzles, wire harnesses, blades, vanes, seals, the critical stuff.
And they've always been in aerospace and defense.
Right. But the crucial third market, and this is the key, is the aeroderivative gas turbine sector. That's the direct link to power generation.
The component expertise is the bridge. Now, we know the terms of the deal weren't disclosed.
No, but the consensus is pretty clear. This deal should be accretive to HEICO's earnings pretty much immediately, within the first year after it closes.
Which is expected in the first quarter of fiscal 2026.
And that accretive nature tells you something. It speaks to the high margins in this kind of specialized repair business. This is not about manufacturing something new. It's an IP and capability play.
A capability that's been proven for decades, right? I saw they have an FAA Air Agency certificate from 1991.
Yes, and that sounds like a dry little detail, but it's a massive operational asset.
Why should we care how old the certificate is?
Because that regulatory legacy proves long-term competence. It shows they've been meeting FAA standards for decades. That minimizes integration risk for HEICO and lets them leverage those repair services from day one. It's a stamp of approval you just can't buy overnight.
Okay, that makes sense. Let's talk about the seller for a second, because the backstory here is interesting. EthosEnergy was a joint venture, wasn't it?
It was, between Wood and Siemens Energy. But more recently, in December 2024, Wood sold its majority stake to a private equity firm, One Equity Partners, OEP.
So PE gets involved.
And they acted fast. OEP saw that Ethos A&C's business, the component repair, was really a non-core asset for the larger group. But for someone like HEICO, it was a perfect strategic fit.
So they just carved it out and sold it to its best home.
A classic surgical M&A move. And HEICO is coming to this deal from a real position of strength.
Oh yeah, their last quarter was record-setting. Sales, income, but the number that jumped out to me was the organic growth, 13%.
That's the number. It means the core business is just humming along. And that strong organic growth, plus their cash flow, lets them be super selective with these acquisitions.
And it keeps their debt low. I think the net debt to EBITDA was, what, under 2?
It was 1.86 times. They have plenty of M&A firepower for these kinds of targeted niche buys. They aren't buying huge companies. They're buying capabilities that are almost impossible to replicate.
Okay, so let's zoom out to the wider MRO market. We keep hearing about this MRO supercycle. Why is component repair specifically such a hot ticket right now?
It's just a perfect storm, really. The market is back, bigger than pre-COVID. It's projected to hit $120 billion in 2025.
And that's driven by older fleets, planes flying more hours.
Exactly. But this boom has just shattered the supply chains. So for an investor, the money is pouring into engine MRO because the margins on materials are so high. And right behind that, the number 2 most attractive segment is components, the very thing Ethos A&C does.
So HEICO is buying into the sweet spot. What are the biggest headaches this deal helps them solve for their airline customers?
2 things. It's all about material shortages and turnaround times, TTs.
And the shortages are bad.
They're the number 1 disruptor, according to industry executives. You can't fix a multi-million-dollar engine if you're waiting months for one tiny little seal or valve. That's the bottleneck.
So if I'm an airline, why do I care that HEICO bought this small component shop?
You care because your planes are sitting on the ground. 3/4 of the industry reported worsening TATs for engines. That downtime costs a fortune. Your $50 million asset is grounded, waiting for a part.
I see. And the main reason for that downtime is just not being able to get those little piece parts.
That's it, exactly. And this is where HEICO's entire business model shines. They provide an alternative to the OEM, the original equipment manufacturer. And they do it through two main channels, PMA and DER.
Okay, let's define those because this is really HEICO's secret sauce. What's the difference?
So PMA parts manufacturer approval is when HEICO engineers and manufactures a brand new replacement part. It's functionally identical to the OEM part, FAA approved, but usually at a lower cost.
Got it. PMA is making a new part from scratch. What's DER?
DER, or Designated Engineering Representative Repair. It's about fixing the broken part you already have. An engineer develops a unique FAA-approved repair for a damaged component.
So a part that might have been scrapped?
A $50,000 part that would have been thrown away can now be safely repaired and put back into service. So PMA is a cheaper alternative to new, and DER is an ingenious fix for what would otherwise be trash.
Right. And bringing Ethos A&C in-house deepens that capability.
It deepens their vertical integration. They get more control over piece part repair, which means they can attack those bottlenecks and deliver faster TATs than competitors. That is why the market gives them a premium valuation. They are the primary problem solver for the industry scarcity issue.
Okay, that all tracks for aviation. But here's where it gets really interesting. HEICO's management explicitly said this was to support fast-growing global energy demand fueled by the AI revolution. That's the real pivot.
This is the hidden growth engine in the deal. Think about it. Data centers need a colossal amount of power, and it needs to be reliable, and they need it online yesterday.
They can't wait for a traditional power plant to be built.
No, that takes years. This is where aeroderivative gas turbines come in.
So explain that for someone who doesn't track industrial power. What is an aeroderivative gas turbine?
It's basically a jet engine, a proven aircraft engine design, but it's mounted on the ground and hooked up to a generator. They're modular, they're efficient, and they can be deployed much, much faster than a legacy industrial turbine.
I see the connection now. AI data centers need power fast, and these ground-based jet engines are the solution.
Exactly. And the components inside them, the fuel nozzles, the blades, the vanes, are basically the same parts Ethos A&C has been repairing for decades. HEICO is just taking its specialized MRO knowledge and aiming it directly at the infrastructure build-out for AI.
Is this a big enough market to really move the needle for a company HEICO's size?
It is rapidly becoming a huge vertical. The energy demand from AI is just staggering. By buying Ethos A&C, HEICO immediately expands its addressable market beyond just aviation into this high-growth industrial sector.
So they're not making the chips, but they're making sure the lights stay on so the chips can run.
That's a great way to put it. And that focus on servicing essential constrained infrastructure helps explain why the market is okay with their premium valuation, a PE over 53.
It shows they're always looking for these fragmented, high-margin markets where their core skill, cost-effective repair gives them a real edge.
But not just riding the MRO supercycle, they're using it as a launch pad.
Which brings us to our final segment. We take all this analysis and spin up an outrageous but plausible trade idea for you to think about. And remember, this is not financial advice.
Right, so our thesis here is built on one idea. Speed and flexibility are now the most important things in power generation. AI infrastructure demands power in months, not years.
Which means the adoption of these aeroderivative gas turbines has to accelerate. And Ethos A&C gives HEICO a dominant position in repairing the components that keep them running.
So the pitch is a synthetic long position. You go long HEICO, you're betting their repair capabilities will deliver outsized growth as they serve both the constrained aviation market and this booming flexible power sector.
And you pair that with a short position against a legacy industrial giant, one of the big established names that makes and services the traditional slow cycle large frame power turbines.
The bet is that the market is underestimating how fast AI demand is going to shift the power mix. It's a shift toward decentralized, fast deployment solutions. HEICO efficiency in servicing those solutions gives them a critical advantage over the legacy players who are locked into multi-year, multi-billion-dollar contracts.
It's an agility and efficiency trade, basically, fueled by the timelines of data centers.
A very compelling way to play it.
So the core takeaway for you is that HEICO's acquisition of Ethos A&C is a really smart strategic move. It leverages their MRO strength to capture share in both aviation and the AI-driven energy boom.
It's a masterful play.
And here's the final thought we want to leave you with. In a world that's increasingly defined by supply chain weakness and shortages, where is the real financial leverage? Is it in making the original equipment? Or is it in controlling the specialized means to maintain and repair that equipment for its entire life?
Something to think about.
Thank you for tuning into the deep dive. This is not financial advice. We are not investment advisors. All information provided is for informational purposes only. Do your own due diligence and consult a qualified financial professional before making any investment decisions.